Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank by applying the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. With us today, I have Taylor Loht. He is on a mission to teach busy professionals how they can invest in real estate without dealing with tenants, toilets, and termites. He highlights and distills the knowledge, experiences, and lessons of expert real estate investors through his podcast, The Passive Wealth Strategy Show. His goal is to help listeners and investors build lives of abundance and escape the Wall Street casino. He believes that building passive streams of income is the best path to wealth generation, not the typical boring, don't have the $4 latte you enjoy twice a week. Enjoy your latte and buy some property. Taylor helps busy professionals passively invest in real estate syndications through his company, NT Capital. He started and runs the monthly Richmond Multifamily and Commercial Real Estate Investors Networking Group, now nearly 700 members. His online networking group meets every second Tuesday at 8 p.m. Eastern. Taylor and his fiancée, Sandra, live in Richmond, Virginia. Outside of real estate investing, he is passionate about Brazilian Jiu-Jitsu and has been trading since 2015. Taylor, welcome to the show.
Hey, thanks for having me, man.
Glad you're here. I'm excited to talk about real estate. Before we do that, can you tell us more about your background and how you got into real estate?
Sure, absolutely. And I guess I'll rewind the clock that I only had this realization somewhat recently, but that the world has shifted this much. But I'm old enough to have had a job, and not my first job. My third job was at Sears, of all places. So that dates me a little bit. And at that time, I'm again old enough that I remember the days when bank accounts actually paid interest of any kind. So that's kind of the first money decision that I can remember making is I took my paycheck from Sears, which was tiny, but it was something. It was something to me. And I wanted to turn it into more. And the only thing that I knew about was bank accounts. And I saw that a different bank in my area had money market accounts that at the time I could make something like 5% in that money market account. And I got whatever, $100 bonus for putting a couple of direct deposits in there. And to me, that was like, I'm turning my money into more money. Deal. I'm doing it. Years go by as a teenager at the time, right? But years go by, get a college degree, graduate, start making, big boy money, realize I need to turn this into something more. So thing that I did is I took a minor in economics. So I knew a little bit about that. And I picked up the book, The Intelligent Investor by Benjamin Graham. That was my first education into real, big boy type of investing. Started investing in index funds, but I was, I have a background in engineering. I was doing the math on this, realizing that this isn't really going to do for me what I want. I need to do something else. I need to make more money or something. I need to get something back out of these investments. So I would continue down the typical path that I think most people are probably familiar with. I started to go down the path of getting an MBA, studied for the GMAT, got a pretty decent score. But right around that time, when I was about to start applying to business schools, I picked up this pesky little book that so many people might be familiar with, Rich Dad, Poor Dad. And that was like, I already had misgivings about spending $300,000 in tuition, board, opportunity costs, and all of that on going to business school just to buy myself another career that I didn't know if I wanted anyway. I had misgivings about that. And I read this book and I'm like, cash flow, real estate, that's it, right? And that really is what started me down the path of real estate investing. I was listening to real estate podcasts at the time as well. Many of those are still around. And, kind of took it from there. That got me into real estate investing.
I love how you mentioned, you were doing index funds and you're like, this is not for me. So that's a really important part, right? In financial planning is like, is it for you? Like, is this going to align with your goals? I get it. Like just having money in index fund and maybe might be good for like accumulating wealth over the next 40 years. Sure. But is that relevant to you? You know what I mean? And for you, it was cash flow. Now you found like after reading Rich Dad, Poor Dad, that like cash flow from real estate was for you. So walk us through that process. What did you do? Did you buy like a duplex? Did you what happened when you first got into real estate?
Great question. So I have and always had kind of big ambitions. And some people might want to say persistent. I say stubborn because that's a little more pejorative, I suppose. But the first few years of real estate investing for most people, myself included, it's education, it's learning how the business works, and it's kind of jumping around between different strategies and asset classes to really find one that really speaks to you. So when I first got started, I went down the path that, everybody's familiar with, of looking at single family rentals, learning about flipping, learning about wholesaling. I knew immediately wholesaling wasn't for me, but the ones that people tend to be familiar with. And I'd put offers out on properties, but I wasn't really passionate about any of those strategies. So continue learning. And I eventually learned about real estate syndication, and that enables people to basically buy bigger deals and acquire bigger properties. And that just got me so excited. I was fired up when I learned about that. I was like, the numbers are huge. You can bring people in, you can be involved actively or passively. And, maybe a little viscerally, I remember, to go back to, my journey with money, I suppose, is I got out of college. I had a job, an engineering job that I hated, frankly. And it's not anybody's fault that I hated it. It was the wrong fit for me. I was the wrong fit for it. They're great people there. I'm still friends with some of them. No problem at all, but it's just the wrong fit for me. And I was driving to work one day, leaving my townhouse that was relatively cheap at the time, driving my 2001 Volkswagen Jetta that ran okay. And I drove past the office of the townhouse complex, and I saw an Audi A8 sitting at the office of that office complex. And I knew to myself, that's not somebody that works in the office, right? That's probably somebody that owns this complex. It could be somebody else, I don't know. But this time of day in this area, that's probably one of the owners of this apartment, of this townhouse complex. And that just has stuck with me since then. It's been well over a decade since then. But once I learned about syndication, I kind of had this realization. I remember that experience that, that person driving the A8, I mean, they're probably, do pretty well financially, but shoot, they may not even own the whole thing. They probably don't, right? They probably built a company, or they're involved with a company where they can acquire these assets with passive investors, make a nice return, and get themselves a pretty sweet car. I like cars. I drive an okay car. It's not fancy, right? It's a nice car, but it's not fancy. But I love looking at nice cars, like Audis in particular. So that has really stuck with me. I don't know why, I don't need an Audi A8. I'm fine with the car that I have. But that experience really spoke to me when I learned about real estate syndication. And I just remembered kind of putting the pieces together of, that's how that works. This person probably didn't have all the money to buy this big complex on their own, but they found a way to make it happen. And that stuck with me. So I really took it from there and started investing in syndications passively. And then I got, on the active side, and this is summing up years and falling on my face and getting distracted. So it wasn't a smooth road, right? It didn't go really, really fast. It took a long time. But I think if you stick at something, you keep working at it, you don't give up, then your odds of succeeding are pretty good. Not 100%, but pretty good.
Absolutely. I would say that most buildings, like large apartment complexes, self-storage, like things that are like really expensive, great in value, probably have some syndication behind them, right?
Mm-hmm.
There's limited partners, there's more people in investing into those deals, which makes them possible. It makes it possible. Like I used to live, when my wife and I first got married, we lived in an apartment building that had 450 units in Chicago. So that probably had, a syndication behind, or a fund that was managing it, because of, it's probably going to be too much for one person. It's possible for one person to own it, but probably you could do more with a syndication. So to kind of like give more like clarity to the listeners, like in simple terms, I guess, what is a syndication?
Absolutely. In very simple terms, as simple as I can make it, it's basically when a group of investors pool their money to acquire an asset. Usually you'll have a couple of people, one to a handful of people, who actually take the reins, take the more active role. And then most of the people in that group are just passive investors that are, vetting the people that are running the deal, typically called the general partners. They're vetting the general partners, vetting the deal, but then they're just placing their capital. They're passively along for the ride. They're not making active decisions on a daily, weekly, or monthly basis, and just receiving a return as long as things go to plan.
That makes sense. So they're limited in the sense of liability and in the sense of work. So they're not having to show up to anything. They're just simply investing in the deals. Now I've heard of a term. I don't think it's an official term, but like passive and active combined together, where somebody's like, is that a such thing? Like passive investing?
I don't suppose I don't suppose I've heard that, but on that topic,
Yeah.
I think people kind of sometimes get a little too focused on, I need to do one or the other. I need to be an active investor only, or I need to be a passive investor only. And the reality is that, most of us have more capital available that we can actively deploy, for one. And then for two, for the purposes of diversification, I think it's just smart to really do both. Put some money passively in other people's deals and do your own deals actively if you're, so motivated to do deals actively.
Got it. Okay. It makes sense. And this is where like the networking comes in, right? It's like if you're out networking, you are kind of networking on both sides, where you are probably raising capital for your deal as a general partner, and then also investing in other deals as a limited partner. Is that kind of how you are right now? Are you kind of both of a general partner and a limited partner?
So, my role has shifted over the years, but I've got securities licenses. So, we just through a broker dealer, we work with sponsors to help them raise capital, raise limited partner funds. And then for most of the deals, I'll invest my own capital as well. And then for, I host my own podcast, right? Where you've been on my show, and I have syndicators on. I know a lot of syndicators, spend a lot of time in this. So I get on their deal lists, and I have retirement account funds that I can't put in my own deals that, I'll deploy into their deals, as well. So I do kind of try to take both roles as best as I can. And, again, get diversification, get exposure to other asset classes and areas that I'm not involved with. Plus, in my personal experience investing in this space, passive investing is still a great way to learn the business. You don't learn as much, as compared to doing things actively, but you still can get quite a bit of exposure to the knowledge and lessons of real estate investing.
Absolutely. Yeah. It's when you join that deal as a limited partner, you have to understand the agreement. You understand where the property is at. You understand what kind of property it is. You understand the returns, the projected return. So that gives you a lot of exposure, right, to real estate. Not as much as you being the active investor, general partner, but it does give you more than nothing, more than no real estate experience at all. You mentioned something. Oh, you use retirement account. So that's like self-directed IRA, or am I right about that?
Yeah, self-directed IRA, and truthfully, we can dig into that if you want. My experience, self-directed IRA, but that's how I got started investing in real estate. Is I had capital and cash, and then retirement accounts because again, when I got that big boy job, I saved everything that I could. I kept my expenses really low. I drove my 2001 Jetta until was that 2018, and it held up well, right? But I had to get a big boy car at a certain point. And I, again, kept my expenses really low, saved money, and then, I had capital to deploy. So I learned about self-directed IRA investing, and in, I think it was 2016, I finally found a deal I wanted to invest in, and I did. We can dig into that, but more generally, I still had the self-directed IRA, it's still invested in syndication, but I'm over it. I'm completely tired of it. I think there are downsides to self-directed retirement account investing that I don't know if they're spoken about enough by a lot of folks who are in the space, who maybe are, custodians or trust companies, but also those of us, with personal experience using the accounts. We have just different opinions about what the level of aggravation that we'll deal with is. But to me, there's UBIT involved, which is a tax that self-directed IRAs can have to pay, that is incurred whenever you have leverage, which if you're investing in a syndication, there's probably leverage. There's probably somebody taking out debt, so you're going to pay tax on that. Talk to a CPA. I don't prepare my own tax. I have to have a CPA do this stuff. So talk to a CPA about it if you're considering this. But to me, it's another tax return I have to worry about. It's another deadline I have to worry about. It's another CPA I have to pay because it's a different CPA than the one that I pay for, my own taxes. It's just, it's more headache, more aggravation than I really, care to deal with at this point. So when and this is probably going to be, I've spoken with the general partner, probably going to be another year, maybe 2 years until the deal sells, which is, fine. It's not the end of the world. When that sells, I'm probably going to do something different with the self-directed IRA. I haven't really decided yet, but after, years of just having to file these returns, and every year I'm already dealing with the deadline for myself, right? But the tax deadline for myself, but there's a tax deadline for the IRA too. It's not worth the headache to me. So other people have different feelings about that, right? I'm not telling anybody don't do it. I'm just sharing that the aggravation and the extra headache to me is not worth the time. I'm kind of weighing between whether I want to put that back in the public markets, which we can talk about the downsides of that, of course, right? Or it's a Roth IRA. Do I want to just cash it out, pay the penalty, and invest it in deals directly? I'm not really sure. I don't know for me what the right answer is, but I'm pretty sure the right answer is not to continue what I'm doing right now. But hey, it got me started, right? It's done well. It's, we've made money, but it's just the headache that I don't want to deal with anymore.
Absolutely. And I think like to provide more details, like, so people have IRAs, right? And they have like, typically when somebody has an IRA, it's like invested in stocks, bonds, mutual funds. You could self-direct the IRA. So instead of it being in Wall Street, you could allocate it somewhere else, like in a passive deal. So let's just say, for example, you have $50,000 in an IRA. You could self-direct it to a deal with you or another general partner. And you're right. A lot of people that I follow on like social media and like just going through like YouTube, like newsfeed, would say like, oh, pay no taxes, use your IRA to invest in real estate. And it's not that simple. Mm-hmm. So technically, yeah, the growth of the IRA funds are tax deferred as they're growing. And as you are getting that money back from deals, technically it's tax free because it goes to your IRA. The IRA, you don't pay tax on until you officially withdraw money in your later years. But the thing is, you mentioned UBIT, right? Unrelated business income tax. That's where, like, when there's leverage involved, it could expose the taxes because the government, I mean, with everything with taxes, I had many CPAs on the show, and they always say that it's never exactly black and white. There's always nuances. There are always things you have to look out for, especially with qualified accounts, which kind of, and then you mentioned, there are headaches involved. It's not that simple. You can't just defer taxes and invest in real estate through your IRA, but there are headaches involved. And it kind of goes to the point of using, bank on yourself, like we talked about in your show, where we leverage a cash value whole life insurance, and in a way where you could invest it in real estate and earn these gains. You won't have the same tax deferred parts when you're earning the income from the real estate deals, but you also won't have the same headaches as you would with the IRA. So kind of just something to look into, for the future when you invest in real estate deals, is to potentially leverage cash value life insurance. Just wanted to put that in there. So what kind of deals do you typically specialize in?
Sure. So I like multifamily and self-storage deals, multifamily apartment complexes and self-storage, the boxes with garage doors that, people put their stuff in when they need to move, they need to transition, they want to upgrade, they need to downgrade. There are a lot of reasons why people will use self-storage. Those are the two that I like right now. Mobile home parks have gotten more popular. I'm not opposed to them. I've seen that space, though, in my time as a real estate investor. That space has gotten so much more populated that I'm a little more concerned about the relative greenness, if you will, of the operators. Some of the operators in mobile home parks that I'm a little more wary about folks getting into things that they might not understand in mobile home parks in particular. So multifamily, self-storage are my two favorites right now.
Yeah, I've been hearing a lot of good things about both of those. It's especially self-storage, because I think like everybody, you always need it, right? Like to moving and different things like that. And plus I think the maintenance costs and other maintenance operating expenses are typically lower with self-storage. I maybe even, correct me if I'm wrong, but I'm not a real estate expert, but correct me if I'm wrong, I think maybe even less than like multifamily, because you have people going in and out actively. There's more usage, there's more potential problems, tenants, things like that. Whereas self-storage, maybe you can run the whole like operation probably with like one employee on staff, if that, right? Like it's very low cost maintenance.
Yeah, there are, many reasons. One that we saw throughout the coronavirus pandemic was the eviction moratorium, right?
Yeah.
That was everywhere. We dealt with that, some of our properties. Fortunately, it didn't hit us too hard, but it's still something we had to deal with and, get money for folks through the assistance programs and all that. But self-storage, that's liens, right? And there's no eviction moratorium for that. There are still rules around what you can and can't do when somebody's not paying. And that's usually on a state level. It gets a little more complicated. That's out of my depth, right?
Yeah.
But that is certainly a relevant aspect. The operating costs are definitely much lower on a percentage basis. The expense ratios are lower on self-storage, a lot less complicated. And there's a lot more room to push rents in self-storage. And I'll give you an example. So I host webinar events. One that we had a couple of months ago was with a self-storage operator who's done, I think, like 100 million in assets, and his goal by 2030 is to do $1 billion in assets. And you know what? I believe he's going to do it. And one of the one of the pieces of wisdom that he shared with us was the importance of pushing rents that he got from another self-storage operator that had done significantly more. He calls his long-term calls his long-term self-storage renters survivors, because he hikes their rates every month so much that they're surviving these rate hikes, which is kind of a little bit of maybe an aggressive thing to call them, I suppose, but it gets the point across that the most experienced and savvy self-storage investors really push those rents to keep people turning over and to keep their income maximized, right? And self-storage in particular as an asset class still has a lot of mom and pop ownership. Mm-hmm. And the mom and pops don't do that. The mom and pops want 100% occupancy. The mom and pops are not using the latest software packages. They don't have websites. They don't have Google Maps like set up that somebody can call in and, just get a unit or go on their website and get a unit. And those are all areas where, say, more savvy, if you will, operators in self-storage can add a significant amount of value, because that's how you get tenants. That's how you get people in. That's how you raise your rents, right? And self-storage, I think, as an asset class generally, still has a lot of opportunity to do that. There are markets that are overbuilt, which is certainly important to be aware of and wary of. That, if it's overbuilt, you could definitely have occupancy and collections issues, right? So you want to be in an area where it's not overbuilt. People talk about the 135 mile radius. They also talk about drive times, things that get into that. But in general, still really like it as an asset class. People talk about self-storage being recession resistant. I hate when anybody calls anything recession proof. There's nothing that is recession proof. I don't care what you're talking about. It doesn't exist. But recession resistance in general is an appealing aspect. Folks can, determine for yourself if you think it's recession resistant as an asset class or not. But I like the dynamics of the asset class, when times get tough, if you will.
And you mentioned like a lot. So I guess one of the ways that you would grow as a syndication in self-storage is by, I think, like finding the deals, right? That's that's a really important aspect of because you can raise the capital, right? You can find all the investors, but you need the deals. And I think that I've talked to a lot of other general partners, and it's finding those deals. That's where like the real, like, I guess, magic happens. So what are some things that you do to find the deals? And what are some methods you have to find those deals?
So there are a lot of folks having success, especially in the smaller scale, still with direct mail and phone calls, especially to the mom and pops out there. You can pull a list and scrub that list to find the owners and send them mailers, right? And just build off of that. A lot of folks succeeding there. And there are smaller properties that are a little too small to be syndicated. Just the dollar value is not quite there, but still big enough to, run efficiently, that folks are doing with, JVs or just through a couple of partners that are active. But I still see that there's a lot of opportunity out there. And if folks out there, you're thinking about self-storage, driving around, I mean, just look around for the ones, around you and see which ones are maybe not well taken care of, or do they have a website? I mean, that's huge, right? That's how everybody today does everything, right? How do you find self-storage? Yeah, maybe you could think of the one up the street and maybe I'll go put my stuff there. But probably you're going to pick up your cell phone. I've got mine sitting right here, right? And go search mini storage and
Yeah.
probably pick the one near you that has decent reviews. And hey, can I book it on my phone? Oh, I can't book that one on my phone. What about the one right up the street? Can I book that on my phone? Oh, I can book that on my phone.
Yeah.
Done. I'm in, right?
Yeah.
So that's where I think there's so much upside. I don't mean to get away from your question, but those are things to look for as far as, finding the opportunity, where there's an upside. I think that's really the biggest sign these days.
Yeah. And I love how you mentioned the tech piece, right? The tech part, you being an engineer.
Mm-hmm.
So I think that that's a huge advantage for nowadays. Like, I think like 10 or 15 years ago, if you wanted to implement like technology in a small business, you would have to hire like a developer, a designer. There was more legwork. It would cost you more. But nowadays, like you could just, everything is prepackaged, like ClickFunnels and all these different software packages are so it makes it easier to implement technology nowadays in your in business self-storage or whatever it is.
Mm-hmm.
I wanted to talk about, so like obviously there's a lot of deals out there, right, to invest from the standpoint of the investors to find deals to invest in. If you were in their shoes, like what are some things you would recommend that they do to find good deals? Like, in other words, what is a good deal, a good investment opportunity?
That's a good question. I think it first starts with the individual. Understand what your goals are, right? You need to understand why you're here, what you're looking to get back out of your investments. Like step back and, look at your personal goals before you start looking out for deals, because that's really going to tell you what you consider to be a good deal versus a bad deal. When you go out into the market and start looking at deals, I think that really the biggest thing, one of the biggest mistakes that especially newer real estate investors make is they feel that feeling of FOMO, right?
Yeah.
The folks that don't know that, fear of missing out. You
Yes.
see this deal that hits your email inbox, you say, oh man, it's closing, next Thursday, because these usually do close pretty quickly. They need the money fast. Oh, I got to get in. I got to, not do my due diligence. Definitely, I would suggest don't try not to feel that feeling, right?
Yeah.
Read the legal documents, vet the sponsor, do your work. It's not, in my opinion, it's not that big of a deal if you miss out on a deal because you took a little bit of time to understand, to build your knowledge, right? Because there will be more. The best sponsors that are in any of these businesses, multifamily, self-storage, mobile home parks, I don't care, new development, industrial, you could just write the list, right? They will have another deal,
Mm-hmm.
right? And if you're just getting started, take your time to understand what's out there. Always read the legal docs, and some of these things can be really complicated. Take your time to understand them. If you need to, find an attorney to help you with that, do that. But, I don't mean to beat this dead horse, but take your time. Don't just dive in before you're ready. Understand what you're getting into.
Yeah, I like to have like a checklist. Like step one, who is the sponsor? Step two, I mean, I'm just making this up right now. Step two, like read the legal, it's OM, right, and the PPM.
Mm-hmm.
Read those agreements and understand the asset class. And then also, does it align with your goals? I love how you mentioned that. That's a problem I see in other places of financial planning, not just within real estate syndication, but other places like index funds, ETFs, cryptocurrency. People just see it as like a good product, and that's not usually the case when it comes to investing and managing your finances. It has to be relevant to you. Like, what is it you want to do? And then you find the investment opportunities that align with your personal goals. That's how you get typically better outcomes and less risk that way when you do your homework that way. And then also too, you mentioned, like, if you miss a deal, like there are a lot of other deals out there and opportunities out there. So that's kind of one of the biggest differences, right, in real estate syndication over the last years, is there are more people that do real estate syndications,
Mm-hmm.
which in a sense could be good and bad, right? It has a mixed blend to it. But in other words, if you miss a deal, there are other deals that are going to come soon. What are some things that are happening right now in, I guess, real estate in general that you see some upcoming changes that you can kind of like project or predict?
Sure. So the biggest one right now is interest rates going up. I mean, the Federal Reserve's raising interest rates to try to tamp down on inflation. There are different opinions about how much they're going to raise interest rates, whether they're going to do it enough. But my expectation is that they're going to try to follow their mandates. And the Fed has a dual mandate. It's stable prices and managing unemployment. I can't remember the exact target with unemployment, but stable prices, which is a modest inflation and keeping unemployment at a low level. Well, right now, there are a lot of jobs, right? If unemployment is not very high, but inflation is very high. So my expectation is that they will continue to raise interest rates until unemployment goes up or inflation goes back down to a level that they consider acceptable, historically, probably 2 or 3%, something like that. So that is relevant to all of commercial real estate, because all of commercial real estate, generally speaking, is financed based off of interest rates that are just above the 10-year treasury. So that all gets into cost of money. Commercial real estate is valued based on its net operating income, NOI, which is basically cash flow after all the expenses are paid except for the debt. And then the capitalization rate, which is basically the rate that the market is willing to pay for free cash flows. And there's a lot of debate around, it's also called the cap rate. There's a lot of debate around how closely the cap rate, the market cap rate, is tied to interest rates. People have a lot of opinions about that. To me, it's hard to imagine a world where interest rates go up considerably and cap rates stay low. I can't picture how that would really work. So if interest rates do continue to go up and they stay at a high level for a long time, then cap rates have to go up. I don't see any other real conclusion there. And I think that will be difficult for the newer operators out there to deal with. They might not see that coming. They might not be ready for more expensive debt on their exit. If they're exiting into a higher cap rate market, that pushes down their exit value. Even if they've successfully added value and raised their income, they might not be able to exit for the value that they had predicted. So they might not be able to make the returns that they had predicted. I think savvier, more experienced operators should be incorporating that into their underwriting and their predictions, and, having a more reliable predictions about where they're going to be able to exit those opportunities. Now, multifamily in particular there's a wrench that gets thrown into the works here, because rates going up on everybody, right? On commercial paper. Well, rates are going up on mortgages as well. And we already had housing prices going insane, right? There was not much inventory available. So prices were going way up. People had a lot of cash. They were buying properties. They were desperate. They were moving. Now prices are still high, but rates are way up, right? And I'm an investor, but I'm also a person, right? I'm trying to move right now. I'm trying to buy a house. My fiance and I are trying to upgrade. And we've just been beaten up in this market. And I think that will force more people to remain renters, right? If they can't get a house, they have to continue to rent, right? And the population's continuing to go up. So that puts upward pressure on rents, because we're not developing enough housing in any market, really. We're short everywhere. So I see, rents continuing to go upward. I think it's going to be quite a while until the single family market normalizes, till we have, appropriate levels, normal levels of inventory on the market available for people to buy. I think it'll remain competitive for quite a while. And I think rates will probably continue to go up until the economy falters and unemployment starts to go up, which, I think that's what the Fed is looking at. So those are really my expectations moving forward. What that'll do for investors, I don't know. I can't predict the future. I can only try to predict what the powers that be will try to do. And I expect that they will follow the course that they have set out to follow.
Awesome. Thank you for that thorough explanation. It makes a lot of sense when you look at it from the standpoint of interest rates. Who knows what's going to happen? Definitely, I'm excited to see how it's going to play out for the rest of the year. And how can listeners connect with you and learn more about you?
Yeah, absolutely. So if you'd like to learn about passive real estate investing strategies, not just real estate syndication, we talk about other investing strategies on my podcast. and other, things out there, other pieces of content that I put out, just go to escapingwallstreet.com. That's a little landing page we have put together for you. There's resources there, red flags and real estate syndication, things like that you guys can all get for free. If you'd like to learn more about potentially investing with me on a future deal, go to investwithtaylor.com, fill out the form, schedule a call with me, and I'll look forward to speaking with you. You can also find my podcast, The Passive Wealth Strategy Show, where all great podcasts are put out just like yours.
Thank you for joining us, Taylor. I'll put on all the links you mentioned in the show notes below, and I'm looking forward to having you back on the show.
I love it. Thank you for having me this time.
Thanks. To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN, assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.